in respect of financial planning, conventional pensions, investments, anything that is anything that's regulated by the FCA, anything that complements the tax and advice planning at Raffingers. We're going to be joined later through the meeting for the main part of the presentation by Pam Beath and Izzy Gingell from Brooks Macdonald as the investment managers for this aspect of this portfolio. And we thought it was important to try to raise some awareness of what the opportunity of the gilt portfolio might play for certain clients and is already playing for certain clients. And so the presentation is going to be relatively short, probably 10 to 15 minutes. But what we'd like to do is to encourage any questions along the way, as Ashley suggested, and also at any point afterwards, if you do have questions or like to follow up, please contact your account manager or partner at Raffingers, and we're more than happy to follow up with any questions. A little bit about the roles and responsibilities, I suppose, and considering this specific aspect of gilt portfolios, our role for Lawrence and I at Raffingers with clients is to assess suitability and to conduct a detailed conversation with the client to find out that these kind of portfolios may well be the best fit for you compared to other options, and to work through that. And then we would effectively recommend an investment manager. Brooks Macdonald in this case have been pretty much sort of first into the market to recognise what this kind of opportunity is, and have been working with some of our clients so far. So we're very pleased that they could join us for today. So the process would be that we, as the financial planners, would be conducting the recommendation and suitability, and then joining effectively with the investment managers to provide the specialist advice and establish the gilt portfolio. Now, the details of the portfolio and the reasons why you might consider it are really the sort of bread and butter of the presentation. So what we'd like to do is to kick that off and hand over to Pam and Izzy to detail what the gilt portfolio is. And there's no assumption here that anybody on the call really has any background knowledge or specialist knowledge about what a gilt would be. So I think the presentation works, from what I've seen, best to sort of break it down to basic levels. And please, at any stage in the presentation, raise your hand or ask a question, and we'll go back for questions at the end of it. And between the four of us, we'll try to get across what the opportunity is at the moment, and perhaps also how long this opportunity is going to be around for. So if that's okay, Pam, I'll hand over to you.
Okay, thanks, Graham. I thought I'd just spend 5 minutes, literally 5 minutes, just talking a little bit about Brooks Macdonald. The company was actually formed in 1991. So although we're not a household name, we're not new kids on the block. So we've actually been going for around 32 years. We listed on the AIM stock market in 2005, and we've currently got around 17 billion in funds under management. So we're not the biggest discretionary fund manager out there, but we're way ahead of some of the smaller ones. I joined Brooks Macdonald in 2009, initially headed up the Tunbridge Wells office for 10 years, and then Izzy joined in 2013 and was based in the Guernsey office for 5 years before she joined me in 2018 when we set up the Bury St Edmunds office. We've got 15 offices across the UK and Channel Islands, and we opened them on the back of demand rather than just being a dot on the map. And the location of the office is actually really important. Historically, most of our business has been generated through the advisor community, and we've worked very closely with them since the company was formed back in the 90s, and particularly with those who have preferred to outsource the investment management to discretionary fund managers like ourselves. I need to make quite clear, and I think Graham's probably alluded to it, that all Izzy and I do is investment management. We just manage client portfolios, so we don't get involved in any shape or form of financial advice. We leave that to the experts such as Graham and Lawrence and his colleagues. We are increasingly getting interest and business from accountants and solicitors, primarily through the introduction from advisors, which is resulting us being able to do presentations like today, which we're very grateful for. We currently have within the company around 440 employees, including 19 investment managers and 14 trainees, which are spread across the 15 offices. And we're very proactive in taking on graduate trainees and offering apprenticeship roles, as they're basically going to be the future success of Brooks Macdonald. We're very supportive of charities. We formed our own foundation back in 2010 and managed to contribute to really worthwhile causes over the years, for around about 329,000 year to date since we launched the foundation. What we're going to do today is provide you just with a short presentation about the opportunities that do exist in government bond currently. Now, this is a window of opportunity, and it's very reliant, the success of, in terms of what's happening in the interest rate environment. So there's an uncorrelated relationship between interest rates and gilt prices, which we will go through. But once interest rates do start to come down, whenever that might be, these prices are not going to look so attractive. So we're using this particular opportunity as an alternative to cash. And whilst we accept that cash deposits have increased over the course of the last 9 months in particular, again, we don't think that's going to be for the long term. And at some stage in the not too distant future, interest rates for savers in particular are going to be less attractive than they are today. So I'm going to pass over the next couple of slides to Izzy before I come back into the rain.
Unmute myself. Okay, so starting off with gilts and the basics of them. So I'm just assuming no one's heard of a gilt before, so we'll start from the top. Gilts are in effect government bonds, but they're issued by the Treasury. They're called gilts because of their security. So gilt edged, in the olden days, you'd think you'd actually get a slip of paper or whatever from the Treasury to lend money to the UK government. And they're in the whole history of issuing gilts, the UK government has never failed to make interest payments. So they are seen as very, very low risk, secure investments. And what they are is you are lending your money to the UK government. They are like a traditional bond or interest in a bank account, like you would lend money to a bank. They pay you an interest rate based on the amounts that you're giving them. It's exactly the same, just lending your money to the UK government. So that is in effect what a gilt is. Like any bond, you are paid a coupon payment or an interest payment, and with gilts that's usually twice a year you will get your interest payment. They are issued at 100p per unit and they mature at 100p per unit. So if you're buying a gilt when they are first issued, you can expect to get X amount of your interest rate or coupon payment for the whole life of the bond, and you will also get your capital back at maturity. So if you invested £10,000 within a gilt at issuance and it was paying you 5% interest rate, you would get your £10,000 back at the end of the term, plus the interest payments of 5% on that capital. As the sort of next line alludes to, they can be traded at prices above or below par. Par just means parity, so that's the amount that's repaid at maturity. So when we talk about par, just think of 100p per unit or £1 per unit. The gilts you're able to trade them in the secondary market. So throughout the whole life of the bond, whether that's 1 year, 5 year, 10 years, you can trade in and out of them on the secondary market. And the price of the gilts themselves can be above or below that par value, depending on their attractiveness. And that is generally based on where interest rates are at the current time, will depend on how attractive a certain gilt is in the market. So if we think, for instance, a gilt that is trading at has 1% coupon payments or interest payments, at the moment they don't look that attractive on the basis of their interest payments alone. So as we've seen recently, and I'll go into sort of the background as to why now, a lot of those bonds issued by the UK government aren't seen as very attractive, so they'll be trading below parity at the moment, so you can pick them up as a discount. On the flip side, gilts can also trade above par, so they could trade above that 100 pence per unit. The main reason behind that, going back to the security of the assets themselves, a lot of investors will look at a gilt that may be attractive based on its interest payment, but also as a safe place to put funds. Just finishing off with the basics of gilts, the total return are made up of two components. Like I said, the income that you will receive, so that's your interest payment, and also any capital gains that you may get. So if you're picking up these gilts in the secondary market below that parity value, below 100 pence per unit, you will have a capital gain if you hold that bond to maturity. As I said, the UK government has never failed to repay investors' cash. We'd hope that would remain to continue in the future. So we can pretty much bet our bottom dollar on that. If we hold a gilt to maturity, we will get that 100 pence per unit back. So you'll in effect guarantee that capital gain if purchased below maturity, below par until maturity. So why now? And Pam and myself, over the course of the last 10 or so years, haven't been investing in gilts within client portfolios because we've been in this period of ultra low interest rate environment. So a lot of bonds issued by the UK government would have had attached to them really, really small interest payments. So the sum that Pam will go through, you'll see on the next slide. The UK government has been able to issue bonds and issue gilts with an 1/8% interest rate or coupon payment, so 0.125%. In the period of very low, ultra low inflation, ultra low interest rates, because that gilt is secure, low risk investments, people have still been investing in them, but they haven't been that attractive if you compare that against the returns of US, some technology companies over the last 10 years. However, what we've been seeing now, and as we're all very well aware, we've had the fastest rise in interest rates since the last 40 or so years. The pace of inflation has continued to rise in the UK. So some of these bonds and gilts which the UK government have issued with really tiny interest rate attached to them are becoming less attractive. So they are trading very much below par, below that 100 pence per unit. What that means is that is positive for clients who potentially have got large sums of cash in taxable accounts, because the capital gains on gilts are exempt from CGT and corporation tax. So where we're looking at, you may get a small interest rate or in coupon payment on these gilts, you're actually getting a massive pickup in the capital gain if you hold them to maturity. And I'll leave Pam to go through the examples on the next slide. The net return is very much dependent on investors' underlying rate of tax. So if you're a higher or additional rate of taxpayer for your income tax, because a small proportion of the return on gilts will be income tax, the vast majority of the total return you will get from gilts will be capital gains, which is exempt. So that's where we're seeing a real opportunity for clients and companies who have got large deposits of cash on the balance sheet or sitting in bank accounts that are potentially being taxed from an income tax perspective. If you flip it on its head and invest in a low risk gilt solution that has the vast majority of capital gains tax exempt funds for your return, then the comparison is quite stark. There's a limited opportunity. So we're seeing inflation numbers, I think, come out of the US earlier today. UK inflation has tended to be stickier, but it's Brooks Macdonald's view that over the midterm, especially towards the end of this year and next year, we'll be looking at the UK government pausing or cutting interest rates within this current environment. So when we start to see that happen, we will expect some of these gilts to tick up in value and become slightly more attractive than they are at this level. But as we're seeing in the prices that we're seeing, it's a real short sort of period of time where we think that these gilts might stay at these attractive levels. So that's why, you know, this period of time when we're looking at gilt-only portfolios, we think that there's a real good opportunity for those types of scenarios. So I'll move this slide on, and I will let Pam go through some of the equivalent yield examples.
Okay, so basically we've got, you know, half a dozen or so gilts that we are currently buying in our portfolios. The first column, as you can see, this is basically giving you the interest or the coupon, as it's called within a gilt, that is payable on an annual or biannual basis. So none of them look particularly attractive. One of the most interesting columns in this table is the price, because as Izzy has stated, all of these gilts, irrespective of when they mature, have got to come back to 100. So if you're buying a gilt today, even if you take the first one, you're buying it at 97.14, you know that price has got to come back to 100 if you hold it to January 24. Now, some of the prices for even just a year out, like the 2025 or the 2026, are looking even more attractive. Now, what this means is that you're getting this coupon, you're going to get that guaranteed paid to you twice a year. But what you're also building in here is some capital growth, some capital appreciation by holding this to maturity. Now, if you were to sell the gilt before it matures, you're not guaranteed the same return. So it's quite critical that we see this opportunity as attractive as it is, providing these gilts are held to maturity. What you've got in the next column is the number of years that basically you've got in place until the gilts mature. We actually see this being most attractive in what we call the shorter end, shorter duration gilts. So those gilts maturing in your 3, 5, 4, 6 years, for example. The reason being is that they're much less sensitive, or the pricing is much less sensitive to expectations of interest rates. If you look at gilts that are maybe 10, 15, 20 years, you know, clearly they're going to be much more sensitive to future interest rate rises. So this window of opportunity does look most attractive in the shorter end of the market. One of the most important columns to look at is the yield to maturity. So this is basically the return you are going to get if you hold that to maturity. But what makes this more interesting, if you look at the next 3 columns, this is the equivalent interest rate you would need to get from bank deposits or other sources to get that return. So if you're a 45% taxpayer and you're investing, you know, money in the bank or some institution, they would need to be paying you 9.34% for you to get that return of 5.2%. So, and also if you go to the end of the table, it shows you the taxable equivalent yield that if you've got a corporate account, and what you basically would need to get in a business account to achieve the same returns. So a number of these gilts, these prices do change during the day. At the shorter end, the changes can be minimal on the upside or downside, maybe a penny or 2 or whatever. They're not significant moves, but anytime the outlook for changes in interest rates, for example, there is a consensus that interest rates may actually peak around about 6.5%. And if they do that, and until they do that, we actually think the pricing of these products is going to remain particularly attractive. If interest rates were going to come down, you know, quite sharply between now and the end of the year, which we don't think that will be the case because, as Izzy has said, inflation is much stickier in the UK than it is elsewhere, then that's where we're going to see a difference in the pricing. These prices are going to rise, so which means your proportion of capital growth is going to reduce. So we're finding the opportunities, you know, gilts that are going to mature in 2028, for example, the January 28 at the second bottom to the table, you can buy at 80.37, knowing that price in 5 years' time has got to come back to 100. So The attractiveness is if they're held to maturity, but they are tradable daily. If your circumstances change and you had to redeem, you can, because there is a liquid market out there. On the next slide, there's just some, for anyone that's interested, how these figures are derived at, just explanations of how these, what these basically the terms are. So the coupon being the interest rate basically that the gilt is paying, the pull to bar being the annualized capital gain, or the loss if it's held to maturity, and then the yield to maturity being the total return if held to maturity. But it's the bottom table here, sorry, the bottom statement, which is the taxable equivalent yield, is what we're really pushing to clients, because this is the required return from a fully taxed investment. It could be an NSI bond, or it could be cash in the bank, but that's equivalent on a gross basis to return you would get. On the next slide, Izzy, if you want to jump in here.
Yep. So just bringing the taxable equivalent yield to life, really, we've looked at a comparison versus the NS&I direct saver, the rate that is on the website at the moment. One of the reasons why we've used this as an example, the annual interest rate 2.85%, we're very well aware that some cash bank accounts are giving you a higher rate than this. One of the reasons why I've used NS&I is that it's also 100% backed by the UK government and Treasury, so it's a similar level in terms of security of funds. So this was their published rate at the end of June, and it's against the January 2025 maturity gilt, which pays you 0.25% interest rate versus the NS&I interest rate of 2.85. The rest of the return will be that capital gains uplift. So we've used that yield to maturity as the return on the gilt, so that 5.19. So you can see on the NS&I direct saver, you just get your interest rate. So just over £7,000 if you're holding this type of savings account. The gilt, you obviously have much smaller interest rate because the 0.25% coupon is much smaller than the 2.85, obviously, but the remainder of the return comes from that capital gains that you would get by holding this gilt to maturity. So we're buying that gilt below 100p, so that uplift to £1 per unit at maturity is your capital gain. Now, where this makes a difference on different tax rates is you'll see the bottom slide, or the bottom table, on the three different personal tax rates. So we've assumed that your annual allowance has been used elsewhere, so just trying to keep it clean as a comparison. So the NS&I, you would be taxed 100%, be taxed on the annual interest rate at your income tax rate. So from a 45% taxpayer, you would be paying the 45% on the 7,125. So your net return, what you would be left with, would be that 3,918. On the comparison below, so the gilt, what you would be left with as a net return would be just over £12,500. That's because you're only paying income tax on that £675 of interest, or the coupon payments that you'd be receiving on that gilt. The remainder of the return, so that £12,308, would be completely tax-free of capital gains tax and exempt also from the income tax. So you'd be left with that plus your net interest that you would get after tax. So the difference between having a large amount in a bank account potentially, which is in not tax efficient wrapper, paying income tax, versus an instrument like the gilt where those capital gains are exempt. And that's exactly the same for corporates too. So you're exempt from corporation tax on that 19%, 20% level. So it's exactly the same on that side too. So there are real beneficial tax advantages by holding something like a gilt versus your standalone bank account paying interest rate. Some factors just to consider. Obviously, Pam's mentioned that The price can bounce around on gilt. So if you don't hold it to maturity, there is a potential risk that you may be selling a gilt which is at a lower price than potentially what you bought it. One factor to consider is that we can put together a redemption ladder. So that table that Pam went through, there are redemptions every year, sometimes twice a year. So if you have liabilities that are due within a certain year, we can invest funds so that when the gilt matures, they become available for paying, whether it's any sort of company bills, school payments, any particular income requirement you may have. So we can have maturities put on a ladder for you to redeem when necessary. And some alternatives, I've mentioned NS&I backed by the Treasury, and your savings are guaranteed by the UK government. There are also deposit accounts from varying different banks paying varying different interest rates. One thing to note there that of the financial services compensation scheme, where your money is in a bank, you are only covered up to £85,000 per person if that said bank was to go bust. So that's one thing to consider. And lastly, I suppose NS&I, it's a £2 million cap on how much you can invest into the direct savers, I believe. With a gilt and gilt portfolios, the amount you can invest is unlimited. So that's another option. That wraps up our presentation. So Graham and Lawrence can hand over to you. And also, if anyone has any questions, please feel free to put your hand up, or if you're shy, write in the Q&A box.
Thanks, Izzy. Thanks, Pam. I think most of that is, well, all of that was really well summarised. It's the opportunity really lends itself to the higher rate of tax that you pay, and if your cash is sat in a bank, whether it's personally held or through a company, the rate of which, for example, you'd walk into a high street bank as a 45% taxpayer and ask them for an interest rate that will return the equivalent tax is as high as 9.5%. Well, we do cash management here at Raffingers, and we're seeing £85,000 compensation limit accounts of around about 6 to 6.5. And then from there, the individual account holder has to pay their tax on that. So this is an opportunity, I suppose, that lends itself, I think, to the higher rate of tax you pay and the more cash you have, the greater the opportunity. And I think also when we look at the laddering aspects and the time to maturity, which Lawrence and I will ensure would fit into a client's planning, the more time that you invest in, even over these relatively short periods, the more opportunity you have for this tax-free gain, this pull to pass. So it's a case of looking at the opportunity while it's here compared to other opportunities. And I think it's fair to say, when you look at other capital at risk short-term investments with the government backing of the guarantee, I don't think we would probably look to consider any alternatives in the short term that could beat it. So I think as long as you're holding to maturity, from a tax advantage point of view, you've got here an opportunity which is probably as good as anything else there is currently. And for that reason, we wanted to sort of raise the awareness and kind of put it out there for discussion. There's a lot of technical detail in that presentation as well. So if anybody would like to raise any questions or throw anything in for a discussion, we're more than happy to answer that now.
Yeah, another thing I suppose that I'd like to add there, I mean, normally the word guaranteed is banned in financial services, right? I mean, there's no such thing as a guaranteed return, but this is one of the very few instances where we can, hand on heart, say that as long as there's a budget in place and we do a bit of cash flow planning and we figure out when you're going to need your money and how much can you afford to lock up for these periods of time, And if you just put it in there, this is really a set it and forget it kind of thing. You know, you hold it to maturity, you'll get your money back, and you have locked in that return at inception. And as Graham has alluded to, this is particularly attractive for those individuals who are faced with higher tax rates or additional tax rates, because there is nowhere else, especially nowadays, that anyone can offer you a guaranteed return, which is going to be equivalent to almost 9.5%. It's just not there, you know. So I think the main thing really here is it's part of a planning exercise. If you look at your cash, look at what your requirements are going to be over the next number of years, and then allocate funds with laddering, potentially, you know, varying maturities. But, you know, it is an opportunity that probably, as Pam has alluded to, probably won't last that long. Inflation in the States is back down to 3% now today. So they're a long way ahead of us, but we probably will be turning the corner on this by the end of the year. And I do tend to agree with what Pam and Izzy have said there. You know, this is probably a limited time to do this, where you're going to get such good rates of return.
Yeah, it's probably worth pointing out as well is that we are really promoting this to a hold to maturity to get the returns that we're showing. But as the narrative does start to change, and it probably will by the end of the year, some of these prices are going to creep up. And you've still got the opportunity to make a return, but you're just not going to get the return that you would do if you held to maturity. So, you know, some investors are worried about tying up the capital for whether it be 18 months, 2 years, 3 years, or whatever, in what is actually an amazingly secure. And you're right, we can't use the word guarantees, but it's probably as safe as you can get, you know, currently, unless the government were going to default in the step.
Well, unless the whole country goes bust, I think we're okay.
Well, let's hope that doesn't happen. But there are opportunities. So if an individual needed to get access to capital, they could still make a positive return on the gilt if they didn't hold to maturity, because the prices are likely to creep up if you think interest rates are going to start coming down. But these type of returns are not going to be achieved, you know, if they were bought today and then held to maturity. So it's just worth pointing that out.
Yeah. And I mean, as always, when you contact, you know, whoever your Raffingers manager is, we can always sit down with someone and run through a budget, run through a plan, and then, you know, look to set something up. And naturally, all initial consultations are free of charge when we're doing that initially, just to sit down. If you want to have a look at this and explore it in more detail, we're always available to do that.
Yeah.
We're very sorry. I was just going to say that. I'll let you go, Graham.
Sorry, Pam, to cut in. I think the last one we set up from inquiry to actually having the account loaded was 2 weeks, I think, to actually have the transaction in and done and recommended. So that was from the first inquiry all the way to, I think it was a check that was paid in.
It was,
yeah. So, and for anybody on the call, once the gilt portfolio is established, you have your own online portal at Brooks Macdonald. You can access and see daily pricing. You can see yourself what the investment is. So, so the process would be, again, contact your relationship partner at Raffingers. Lawrence and I gladly speak to anybody with, you know, just to have the initial conversation. There's no obligation for that. And if it does go, we will get the money invested as quick as possible, but generally within 2 weeks.
Yes, and quicker if it's electronically transferred. So check does tend to hold it up because we have to wait for that to clear.
Yeah, but Graham likes traveling around the country collecting checks from clients, so you know that's fair enough.
That's all good. Listen, I don't know if we have any questions, but Pam, Izzy, thanks ever so much for taking some time this afternoon to explain all of that and to be available. And thank you for everybody on the call. Please do to let us know if you got any questions after this afternoon.
Thanks
very much, guys.
Thank you.
Thanks a lot.
Ashley, if you're still on, we can come back to you if you know the whoever asked it with the answer to that.
Yeah, Darren, I've received your question. We will get back to you on an email, or we'll get one of the guys to give you a ring.
It's yeah, just about if you get the interest, if it's not sold, it's part of the accrued interest process. So if you sell within the income period, and so you've sold your gilt before the interest is received, it's part of a accrued interest process that's paid to you when you sell the gilt, so it's passed on. So if you do sell it before maturity, you would still get your interest that you are owed from that holding period. So it's not like it's lost.
Perfect, thank you. Guys, if anyone has got any other questions, just drop me an email. I can always just point it to the right person. But thank you all for coming on. And if you want a free consultation, let us know. Thank you.
Great, thank you.